Thanks for joining us today for this episode of The Capitalist Investor. I'm Mark Tepper, joined by Derek Gabrielsen. D, what's up?
Mark, how we doing today?
Excellent, buddy. So, look, for today's show, I want to talk about gold, Bitcoin, and crypto as investments. Figured we could have kind of a fun show here.
Yeah.
Because there's different camps. Right, there's gold bugs out there who think you should build a bunker and convert all your cash to gold coins and go and hide in your bunker for the rest of your life.
Yep,
That's not us.
I've seen the commercials.
Yeah, that's not us. Okay. There are those people out there who are claiming Bitcoin, which is worth roughly $9,000 today, depending on when this episode is published. That are claiming it's going to go to 100,000. Some people have said 1 million. Okay. And then there's a bunch of other cryptos as well. There's probably too many of them.
Yeah. There's too many to keep track of.
Ethereum, Litecoin. I mean, there's too many of them. I wouldn't even know which one to start with. So, right. I mean, maybe we just keep it kind of specific to gold and Bitcoin. So, look, people are interested in this stuff. But I think it's important that we talk about how gold and Bitcoin fit into your investment strategy, because I own both. I'm not a Bitcoin bull by any means. I'm not a gold bull by any means, but I think you should own both of them in a ratio of your overall investment portfolio that you're comfortable with.
Right.
And what's your take on either gold or Bitcoin?
So I've had friends and clients, talking to me about Bitcoin and crypto for a long time now, honestly. One of my buddies hit me up about it when it was probably at about $200.
You told him no?
Yeah, I said, hey, I go in with you. If we each, let's throw in, like $500 a piece. And we talked about it and we decided no.
Dumb mistake.
So that would have been about 2 coins a piece. So, $500 into what, about 18,000 now?
Yeah, not too shabby.
Yeah, so that would have been nice. It's still, in my opinion, very difficult to get down to the core of what it actually is. And I've looked at it for a long time. So there is that aspect to it for me personally as an investor.
Yep.
As far as gold goes, I just turned 40. I'll always have a small portion of my portfolio in gold, I think. If nothing else, just really for my grandfather. He's always was a big gold person, and that guy's got gold coins, scattered throughout his whole house. So
buried in the backyard.
Yeah, in his safe, in his office, But over time, and I think in these current times, we've seen it's a nice position to have for both safe, and it's not really in my opinion a true just inflation hedge. That's kind of what you hear out there. And we can talk about that a little bit, but it is a little bit of an inflation hedge, and it's a calamity defense. In my opinion.
And there's we'll talk gold first. So
yep.
It's definitely a calamity hedge, right? I mean, and if we kind of go through and we think about what are some of these potential calamities that could sidetrack us? Obviously, COVID-19 has been front and center. These riots, right? Economic shutdowns, geopolitical tensions with China. I don't know if people listening know this or not, but we are at war with China.
Right.
Or at least China's been at war with us for a long time, secretly.
Right.
They won't tell you, but they've been going to war with us. And finally we have an administration that said you're not going to continue to beat us up.
Right, and get away with what they've been getting away with.
Right. So, I mean, any escalation there could be a calamity. So there's a ton. We give our forecast presentation to our clients every single year at the end of January, beginning of February. And D, we always carve out a small portion of that presentation for like geopolitical risks, right? And typically we just write them off. Right?
Yeah.
I mean, just to shoot straight, like they've typically been a non-issue.
Yep.
Right?
When has there not been some sort of geopolitical risk?
Right. Right. I mean, we were about to go to war with Iran not too long ago, and the market got spooked, and then the market recovered when Iran, I think they shot some missiles at us, but they called us first to tell us they were coming.
Right. And didn't they like miss badly for
they missed
several hundred miles or something.
It was just weird. I don't understand.
It was very strange.
I don't know much about that stuff, but it was very odd to me. But typically, black swan, geopolitical stuff, we gloss over that stuff in our presentations. Like, hey, these risks are out there, but the chances of them happening are slim to none. And if they do happen, here's what the market typically does. It goes down and then it recovers. And believe it or not, that's kind of what's happened with COVID. Mm-hmm. I mean, it went down hard and fast, but it recovered.
It did, yeah.
Right? So owning gold as a calamity hedge, good idea. Owning gold as an inflation hedge, good idea. The Fed just increased its balance sheet from $4 trillion to $7 trillion.
Right.
That money's going to come from somewhere. Okay. Prices will go up. Taxes will go up. We'll likely see inflation. What a lot of people don't understand is that gold is also very effective as a deflation hedge. So deflation is when prices go down. So some people might be sitting there thinking, well, how is it possible that prices go down?
Right.
When demand is destructed, right? Is that a word? Destroyed? Demand destruction.
Destructed?
Destructed. I just made that up. I think that's not a word. Destroyed. Let's go with when demand is destroyed. I just made up a word. When demand is destroyed, when it's beaten up, people make a decision not to buy something today. They put off their purchases for 6. I mean, we're just talking about cars, right? Now, this is more of a supply issue. There's the cars you want to buy are not available right now, right? Because they're not manufacturing them. So stuff like that happens on the supply side, but it also happens on the demand side as well, where people might make a decision not to buy something. So think computers and TVs, right? Especially flat screen TVs.
Right.
I mean, that had to be early 2000s, mid 2000s when the first plasma TV rolled out, 42-incher, probably $10,000 back then.
Oh yeah, no doubt about it.
Ridiculous.
I remember. I'm into that stuff, and yeah, that's what it was.
They were a lot back then.
A lot of money.
But then people started to learn, well, there's going to be something better in 6 months, in 12 months. So I'm just going to wait. And then that $10,000 TV a year or two later is $1,000, and then there's a new one that's $10,000, right? So the prices have come down. What we're seeing now, that's just for a specific product. Same thing with computers, right? Well, my computer's kind of dying, but I'm not going to buy one today because I know in 3 months, for the amount of money I'm willing to spend, I can get one that's got more horsepower.
Yep.
Right? So that, again, that's deflation. That's prices coming down over time. What we are experiencing right now, or what we are potentially going to experience, is deflation at the macro level. That's globally, right?
Right.
How would that happen? How would loaves of bread become less expensive? Milk, cars. How does all that stuff become less expensive? When nobody wants to buy anything. Right?
Hell yeah.
When you are so afraid to spend your money that you are hoarding cash and you don't want to buy anything. That creates a deflationary environment, which is actually more dangerous than an inflationary environment.
Absolutely.
Gold works under all three of those scenarios. Calamity, which we can't predict. But we're likely to see either inflation or deflation. Okay. Now, Dee, let's talk a little bit about how much you should have in your portfolio and how you should hold it.
Okay.
How do you hold yours? Just GLD, the ETF? Or
That's
do you have
what I do.
gold?
I do have physical gold that was basically gifted to me by my grandfather throughout the years.
Oh, nice.
So he would use. He
got
used
coins, bars?
I don't have any bars. I wish I did.
Big, huge bars in your vault downstairs?
I forget, from the movies, the big brick of gold, how much it weighs, but it's something crazy.
Remember Scrooge McDuck?
Oh yeah, DuckTales.
Yeah,
absolutely.
I was watching it with my son not too long ago. He was downstairs in the morning eating breakfast, and I was flipping through. There's nothing on TV, and we've talked about this on prior shows.
Yeah.
If you have cable TV, we all know you might have 800 channels. I can promise you there's nothing on any of them right now.
Yeah, that's my next project, man. I have like 97 subscriptions to Disney Plus and, Netflix and all this stuff. I have hundreds of TV channels I don't watch. I got to get this under control soon.
Well, we're old. That's the problem. If we were 29.30 instead of 39.40, we'd be smart and we would just have Hulu Live TV and call it a day, right? But unfortunately, we still have cable because we're dinosaurs.
Yep.
But Scrooge McDuck, man, come on, diving into his lake of gold coins.
Not going to work.
Man, I wish I could do that.
Have you found the old ones? Because with my kids, I've only seen the new ones.
I don't know. They looked newer. I don't know.
It's more like the new Toy Story animation type.
Yeah, they look newer.
Yeah.
But all right, so you own yours as GLD for the most part, the ETF.
Yeah, mostly GLD, and probably a small amount, maybe like 3 or 4 ounces total.
Cool.
In coins.
Cool. So I own GLD again, which is the ETF, but I've been buying gold coins. Mm-hmm. So I have been buying. I'm going to continue to buy them. Just as an inflation hedge. I'd like to have some physical gold on me. I don't know that everyone has to have physical gold. Mm-hmm. I think owning the physical gold is probably something that I became interested in as we were talking about all this end of the world crap a few months ago when everyone went and bought all the ammo they could and there were talks about people breaking into your house when the riots broke out. And I think it caused me to say, it probably wouldn't hurt for me to have a little bit of physical gold. Now, I'm not going to go overboard, but just to have enough to be able to survive for a few days or weeks if I had to, So, there's certainly different ways to own gold. And then there's also, like the gold miners. Right. So the ways to own gold, you can own physical gold. You can either get the bullion, which are, the gold bars. You can get gold coins. Probably the most popular way that people own it is through the GLD ETF.
Yep.
Right. That's a pure play on gold. I mean, that's going to be exactly what gold's worth, right? So as gold prices go up, GLD is going to go up proportionately. And then there's the gold miners. Like, let's take Newmont Mining as an example, right? Now, they mine more than gold. And I believe they do copper and silver and stuff like that as well. But sometimes people play the trade that way. Sometimes they own the gold miners. And my take on that is, I guess the pros to doing that is your returns could be amplified. Both ways, though.
Right.
When the good is good, like your returns could be amplified on the plus side. When they're bad, they could be amplified on the downside. So, and then you're also buying a company on top of that. Right. So, I mean, if you're looking at an inflation and deflation and calamity hedge, in my opinion, I don't know about yours, but I would rather just own the pure commodity.
Yep, for sure.
Right?
Yep, no doubt.
Because what if Newmont Mining, what if their management team stinks? Seriously.
There's a whole nother layer.
There's a whole nother layer of that. It just complicates it. Right?
And it's going to be, the price shifts are going to be much earlier in the cycle versus where gold is. It's going to be more kind of reacting during the day.
Yep.
I was actually just looking it up. I did have some gold miner stock. I want to say it was like GG, but I must have sold in my last rebalance because it's not there anymore. But it was a big negative.
A lot of them are doing well this year.
Yep. So I think this was at the end of last year.
Gotcha.
So poor timing there, but
a little tax loss harvesting.
Exactly.
And for those of you who don't know, now you know. Sometimes you sell your losers so that you can sell your winners without paying tax, right?
Yep.
While we're on that, you should sell your losers. Seriously, a lot of people hang on to their losers for too long.
Yep.
What's it called? Disposition effect. I just made that up. I hope it's right.
No, you totally nailed it.
Did I? All right.
Oh, yeah.
Disposition effect. So that is where you continue to hold a loser for way longer than you should because you're convinced that it's going to come back.
Yep.
That also goes hand in hand with one of the biggest economic fallacies that we talk about, which is sunk cost. Right?
Oh, yeah.
You remember sunk cost? You should never, whatever, it doesn't matter what you paid for something a year ago, 5 years ago, 10 years ago, you paid it.
Right.
That money's gone.
It's gone.
You should not use that in your decision-making process today to determine whether or not you should continue to hold it. Sunk cost, people, look it up. It's very important. If you want to be profitable and make money, managing your accounts, make good, smart, prudent decisions in business, you need to understand sunk cost and opportunity cost. I'm not going to go into opportunity cost today, but those are the two things you need to know.
And behavioral finance. I think if you're new out there and you're looking to get into some investing, understanding the emotions to it and how it affects your decision making, at least for me personally, and I'm primarily I barely have time for my own stock picks, but understanding that you're just more inherently going to hold on to your losers longer because you keep hoping they're going to go back up, and you're likely to sell your winners more quickly so you can realize a gain. Understanding the kind of psychology to investing makes a huge difference in your when you're actually out there executing investments.
Yeah. And just picking up a book that can teach you that those things make sense, it will change your life.
No doubt about it, man.
Because if nobody told you in writing, because we can say all we want over a podcast and it's going to go in one ear out the other, right? But if you pick it up in writing and you read it and it says, sell your losers.
Yep.
Next time you have a loser, you're going to be less likely to hold on to it.
Yep.
We're way off topic. What the heck are we talking about?
Gold.
Back to gold. All right. So I think the proper allocation, let's have a conversation about this, depending on how scared you are about those three things: calamity, inflation, deflation.
Right.
The right allocation in your overall investable net worth. Now, when I say overall investable net worth, D, I'm talking cash in your savings account too.
Right.
You really should consider that.
Absolutely.
Right? Some people say, well, I've got, $1 million account at Schwab, and then they've got $500,000 sitting in cash and CD somewhere.
Right.
I'm talking about the whole 1.5 million,
right?
Not just the $1 million in your Schwab account or $100,000, whatever it is, right? I'm talking about all of your cash savings and investments. I think the sweet spot for a gold allocation is somewhere between 1% and 10%.
Mm-hmm.
If you're really scared, 10%. Mm-hmm. If you're not as worried, 1%. Now, for our clients, I want to say most of our clients were in like the 3 to 5% range.
Right.
Right. And I think that is a reasonable place to be right now.
Mm-hmm.
Right. What are your thoughts on appropriate allocation?
Yeah, most of my clients and most of our clients, they're approaching retirement or in retirement. We do have a fair amount of, I would say younger clients too, kind of in close to our age range, probably, the 40 to 45 age range. But you look at a year like this year, especially after the bounce that we saw in the market off the lows, in the right environments, gold can increase in value while the market's still going up.
That is absolutely correct.
And you'll get those sweet spots, the sweet year, I guess you'll say, where that can happen. And that's why I don't think and especially in the inflationary market that we find ourselves in, basically 0% interest rates, right?
Yep.
If you're throwing money just to round out your portfolio into a moderate term bond fund, what are you pulling down from that every year?
2%.
Yeah, at best. So when you can replace something like that, timely with an investment like gold,
yep.
I think it can do a lot more for you than maybe those bonds could. Not to say that those bonds don't belong in a portfolio, because they most certainly do. But you don't need to pull money necessarily out of the stock market to get into that nice allocation, which I think, someone, in our age range, I like to do probably between, 2 and 5%.
Yeah, definitely below the 3 to 5 for us, right?
If years like 2019, I'm probably selling out of some of that gold and getting some of that money repositioned into the stock market. But I think I'm a little bit more active than maybe a typical person is. Not just, I'm not out there day trading or anything like that.
Yep.
But what I just said about behavioral finance, I'm using that now, and when
it helps, it works.
When there is a lot to be said for kind of doing the opposite of what you see the people doing on TV are doing.
Yeah.
When they're screaming that, in the middle of this pandemic, and it's been awful. But I remember the headlines on, whatever cable news channel you want to see, projections, 2 million people are going to die. Investing when the blood's in the street, as they say.
Yeah.
It is really something that you can take a look at doing to a small degree. But, again, you want to make sure that whatever that ultimate balance that you have, it needs to make sense for you personally, and you still need to be able to sleep at night.
Right. That's the most important thing.
So figure out what that is, and get into the right allocation. There's a reason for asset allocation. It's because it works.
Yes. And everything I've been reading recently from our research resources has been talking about how the dollar, which has been in a bull market for years, is weakening, and it looks like the trend is reversing. And it makes sense because the Fed's balance sheet went from $4 trillion to $7 trillion. Right. M2's growing by 25% per year. Our budget and trade deficits are just unsustainable.
Yep.
Right? There's talks of more stimulus on the way. So the dollar is going to weaken. And in those situations where the dollar weakens, gold is a very, very good performer.
Yeah.
A double-digit per year kind of performer. Okay, so more reason to have it in your portfolio. But look, I remember back in the Great Recession, clients coming in, prospective clients wanting to put 25% of their money into gold, 25% into silver, and then we'd manage the rest. Like, dude, don't do that much. Like you just can't do that much. So 1 to 10% I think is reasonable.
Yep.
But you need to kind of back into it and go with something that you're comfortable with. All right, on to Bitcoin. Do we even know how it gets its value?
I suppose we probably should, but like I said to start this off, it's very unclear.
It's a mystery.
Yeah, it's very unclear.
So gold is an investment.
Right.
To me, Bitcoin is speculative.
For sure.
Now, I'm one of those guys. It's kind of a FOMO trade for me. I own Bitcoin.
Yep.
Now, only because if it 10x's without me, I'm going to be upset.
Exactly.
So I got to have some, right? I don't have a ton. I have enough Bitcoin that if Bitcoin went to 0 tomorrow, it wouldn't change my life.
Right.
But if it 10x's, we're going to Vegas, dude.
Either way, I win.
Right?
Oh, yeah. That's the fear of missing out, right? So, yeah, I have some. I have no idea where it will go. It's a pure speculation. In my opinion, I think there is a lot to – it's kind of the supply and demand thing, right? When it's out there, hey, Bitcoin's going up. You got to get in. More people are going to buy it. The price is going to go up.
Yeah.
It's really been kind of that simple as far as how the pricing goes.
Yeah.
But, there's a lot of question marks, a lot of unknowns out there, a lot of wild price fluctuations.
Yeah.
So as an investment, as part of a core holding in someone's portfolio, especially in retirement age, I'm not so sure about that.
Yeah.
For people like us who don't want to miss out on something cool.
But look, even if you're retired, let's assume you did a good job saving for retirement. You got $1 million portfolio. Okay. 1% of that's 10 grand. I see nothing wrong with that.
No, absolutely not.
You put 10 grand into Bitcoin. If it goes to 0, who cares?
Right.
If it goes to 100,000, cool.
Yeah.
Like your vacations and retirement are going to be that much better.
Right.
So 1%, in my opinion, is totally cool. Then you ratchet it up and you kind of trial and error again. 2%. What if you put 20 grand in there? All right, maybe you could stomach that. 30 grand. Now maybe it's getting too high, right? But you need to look at your own personal situation and try to look. I don't know how the price is going to change over time. Right. I don't. I actually have. You ever heard of the app Blinkist?
I actually have not.
Okay, so Blinkist is an app that I recently started using. So I typically, I don't do a lot of cardio when I work out in the morning. I typically just do like weight training, and I do it with short enough breaks that my heart rate it turns into cardio anyways. But I was recovering from an injury, so I had to hop on the Peloton. Hop on the Peloton, and rather than listening to the trainers, I decided I was gonna listen to the either music on my iPhone, or I decided at that time to use Blinkist. Blinkist is an app which it's like Cliff's Notes. Remember Cliff's Notes back in the day?
Oh, I remember those.
Oh, I used to use them all the time. I got in trouble for using some of the words in one of my papers without citing them. But so basically in like 10 to 15 minutes, they'll read an entire book to you.
Oh, really?
Yeah. So if I'm on the bike for 30 minutes, I can go through 2 books, right? So I read or listened to the Blockchain Revolution and a few other books on Bitcoin so that I could try to figure out, like, what is this stuff? Because you hear about how great the blockchain technology is, but has anyone ever been able to explain it to you?
No.
Yeah. So in the 13 minutes or so that I listened to these books, I still can't explain it to you.
I thought you were going to drop some knowledge on me.
Well, here's what I know. Here was my big takeaway. What Bitcoin does, what cryptocurrencies do, what the blockchain stuff does, is it eliminates the middleman. It eliminates the need for a bank. Right? Because if you buy a house from somebody, there's lots of middlemen involved. There's the seller of the house. There's the title agency. There's the mortgage paperwork. There's all kinds of stuff to make the transaction authentic and real. With Bitcoin, it's real. It's documented. Boom, it's done. There's no middleman. So that brings costs down. And the reason I bring this up is Bitcoin, in my opinion, will go up in value when its adoption increases, which means companies decide to allow you to purchase their goods with Bitcoin. Now, as a business, we allow credit cards when people, if they want to buy a business valuation or something like that, we allow them to pay for that on credit card, right? There is a fee associated with doing that, right? We have to pay the credit card processors like 2 to 3%, right? So, if you think you're getting $100, you're not. You're getting $97, right? With Bitcoin, there is no fee, right? And I've seen websites that have begun to offer Bitcoin as a payment method, they'll reduce your price by, let's say, 2%, because they're saving 3%, right? So that is where I see the potential for Bitcoin. It is a minimal cost or zero cost way of executing a transaction. That's where the future lies, in my opinion. But you have to see companies begin to adopt it and embrace it in order for that to happen. Businesses have to decide it's a currency they're willing to accept.
Yeah, for sure. And is my understanding, and you can tell me if I'm wrong here, that it also, I guess, the grand scheme of things here is it would eliminate the need for a government-backed currency. So
I think that's the end goal, but I do think there are benefits to it if that were never to happen.
Which is not likely.
Yeah, it's not likely at all. So Bitcoin, right? So we talked gold, 1 to 10% of your portfolio. Bitcoin's not an investment like gold.
No.
Bitcoin is a speculative investment. It's speculation. Where do you think? 1 to 3%?
Yeah, I don't know if I would do it. Well, I guess percentages is good. I have some clients who, just enjoy talking stocks, So we carve out, $50,000 of their, say $1 million portfolio. And hey, we'll always have, 7 to 10 stocks in here. We'll pick some out. When they get up to a nice price, we'll sell them and we'll look for something new. That's kind of the same deal. They're not counting on that money to, make their next mortgage payment in retirement. It's kind of like a, I don't want to say funny money because it's obviously not funny money, but just an account that, hey, we're going to take some risks here and we're going to try to make some money. that to me, that's kind of where
Bitcoin fits.
Where Bitcoin would fit for me.
I agree. It's money that I think whatever you pitch into that Bitcoin bucket, you should throw it in there expecting it to go to zero.
Right.
If you expect it to go to zero and it performs better than that, great.
Right.
But carve out an amount that you would be comfortable with it going to zero and just kind of build it into your financial plan as it's non-existent. It went to zero.
Exactly.
And if you're lucky enough that it 10Xs and we're lucky enough that it 10Xs, we'll all be celebrating.
Yep.
Right?
Take that nice vacation.
Exactly. All right, well, that wraps up today's show. As always, thanks for tuning in. You can email us at info@swpconnect.com. Go check out the show notes. Derek's posting this stuff on YouTube. You can send Derek a message within the show notes. You can send me a message. We'd be happy to talk with you. And as always, thanks for joining us, and we'll talk to you next time.